The following is a presentation of TFNN. The Power Trading Hour with your host, David White. Call now, toll free at 1-877-927-6648. Internationally at 727-445-1044. Now, David White.
And welcome all to another exciting edition of the Power Trading Hour with me, your humble, lovable, and squeezably soft host. Once more into the breach do we go, dear friends. And let's take a quick look at the market. If I can find my mouse, my Mies. We're at 1943 on the S&P cash, 2.62 billion shares of volume, a little much lower than yesterday. What are we running? About 300 million less shares on the New York Stock Exchange at the same time from yesterday. Of course, we kind of slammed down earlier the day at 1932 earlier in the day. It kind of got pushed up into the high end of the range of the day on lunchtime buying, and now we're pretty much just sitting flat on the day in the S&P cash. Although I suspect, and we'll get into it in a little bit, that we're going to see kind of a close that is a little dour, a little bitter, and a pill to swallow for some of those folks that went out on margin. And one of the reasons why I don't use margin except intraday, and then maybe 2 times a year, maybe 4. I mean, and normally I don't go home. In fact, I can't remember a time I've gone home in the last 4 or 5 years on margin. But it is exactly what you think it is. It is a double-edged sword. Almost always, though, the problem comes into being of using it too much. It is a tool like other things, but an extremely dangerous one. My belief is that a lot of people were on margin going into the end of the year, and we're seeing some of that margin come off, especially in the broker-dealers. But the people that were truly chasing, retail customers chasing returns, were probably on margin again this time, and every dip they probably bought and added on margin. And probably today we're looking at some margin calls, and we'll talk about how margin works today also. Trying to think of anything we've got going on. Somehow the puppies have gone all Papillon on me and escaped and are bothering me. You want to show everybody at home how pretty you are? Come here. Oh. Okay, Miss Vixen, you tell everybody just how pretty you are. There you are. Now go back in your home. Go back. Go. Anyway, we had to break there for a Spot announcement. Thank you, Spot. Anyway, what else do we have going on out here? Well, we need to start the show. We really haven't done that. So let's get it started.
And it's all just a little bit of history repeating.
On this day in 1973, the Reserve Fund, the first money market fund, opens in 1973. It opens a day after the article in the New York Times reveals the radical features of an overnight mutual funds business for surplus assets. That's a yield of more than 50% higher than a bank account, plus daily dividends and redemption privileges, and a constant net asset value per share. By the end of January, the fund has $1 million in assets. By the end of the year, it has $500 million in assets. And the birth of the Reserve Fund started in 1973, a place to park your cash. And of course, that's what they're thinking about negative interest rates doing, making sure that people can't hide anywhere. Also on this day in 1829, kind of the opposite of this week, it was one of the quietest days and weeks in Wall Street history. On this day in 1829, not a single share of stocks changed hands, although they were open from 10 to 3. And that would be it. What else do we have going on out here? I wanted to get into some stuff. Just a reminder that I will have a 60-minute live subscriber event on the 20th of January. I've got the first half of a white paper I'm doing that's on the front page of TFNN. Under breaking news, if you click there, you'll start seeing the problem that I identify. Next week, I'll have the back half of that white paper that talks about the solution, and that's for subscribers only. You still have this week to sign up and get your free 30-day trial of either newsletter, The Path of Least Resistance and or the Tech Insider, both of which I will be closing positions on today for some ill-gotten gains, large ill-gotten gains. So check those out. And especially in a bear market, we probably ought to start discussing things that really happen in those. And margin calls is one of them. And understanding how and the technology behind shorting is one. So we'll talk a little bit more about that in the coming weeks, but also the mechanics of it and how we can use those mechanics to profit both short and long. Of course, knowing that there's a giant pile of people that have to cover is always good, because short covering, especially if you can get the calls on it and get them at the right price, one of the sweetest, like ribs, like a good T-bone steak, some of the sweetest pleasures that you will have. Jim Cramer is a moron. I heard him out here this morning, and he was spouting some more stuff that he basically told me why he had run his fund almost totally broke twice. And my question was, why and how can a guy that's supposed to be the maven of Wall Street fail to learn the brutal lessons of the market? Normally I go stupid or liar. I just don't think he's probably not stupid, and he's not a liar. I think that sometimes, unless he ran his account broke, I don't think that people ever learn. And that may be it. But what I wanted to bring up here is understanding both risk and reward. He was telling everybody about how stupid it would be to sell, and that if we turn around in a couple of 6 months or a year, we're just going to be so much higher than we are today, and you've got to be a moron to sell today. And I thought, well, first of all, no one truly knows the future. Secondarily, what else do we know? And that is that most of these guys on Wall Street are always perpetually long. And if you're perpetually long, that means that you're probably seeing markets that close higher than the day before about 75% of the time. Now, that's all good and well. And what happens is, over a number of years, is everybody gets used to it, and the bull way is the only way. You can't really think about a market that pulls back. Certainly if you're a big company like CNBC, you know that only half the people are going to watch in a downturn in the market. 90% of people never go short the market, and therefore the only thing that they know and know what to do is go long. So why does somebody that should know, that ran his fund literally broke without the help of either his wife, his first wife once, who saved his bacon, the second time his partner who threw him out of the company? What can we find out? Why does somebody do that? We're going to talk about risk reward and how Russian roulette fools people. We'll be back in a minute.
TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartley's, ABC's, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com.
Tiger TV is an exciting way to experience TFNN programming. See high-definition video, giving you crystal clear charts, as well as seeing some of the faces of TFNN's highly acclaimed financial experts with crisp, full-fidelity sound. Catch Tom O'Brien, John Logan, Steve Rhodes, Basil Chapman, Larry Pesavento, Think or Swim, David White, Andy Hecht, and Daryl Martin in crystal clear, high-definition audio and video. Tiger TV, exclusively at TFNN.com. Platinum, grains, crude oil, gold, copper, cattle, hogs, gasoline, natural gas, coffee, cotton, cocoa, and sugar. These are just some of the commodities mentioned in the most recent issue of Andy Hecht's Techno-Mental Commodity Report. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Techno-Mental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you will lock in the low rate of only $79 a month. Sign up right now for the Techno-Mental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com. Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows, and have access to all those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com. Dave takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
Anyway, we're going to talk a little bit about why probably big men of the street who haven't lost it all probably can't learn. But I love the book Fooled by Randomness by Nassim Taleb. And in his book, he actually talks a great deal about how risk is a revolver and you're playing Russian roulette. And that the problem is that everybody gets used to spinning the wheel, and instead of 6 chambers, there's 500 chambers, and they keep spinning the wheel. And of course, they put their gun to their head and it doesn't go bang. It doesn't go bang, it doesn't go bang, and over a number of years it doesn't go bang, and they can't even conceive that one of those chambers in fact does have a live bullet in it. And really, when the markets start pulling back, they still can't ever see it because, of course, 75% of the time they've been rewarded by just saying, no, it isn't, no, it isn't, no, it's not different now, we're only going up, it's only going to be temporary. And for the most part, you see the markets moving down far in advance of when the mavens of Wall Street on CNBC get up there and talk. But as if you saw yesterday or the show, we were talking about Apple and how many people had lined up and were just talking about Apple like it was going out of business, where a month ago these guys couldn't have talked up Apple any higher. And of course, when you talk to them or when they were asked yesterday on CNBC, they started saying, oh, we've been selling that for a year. And that's the way it goes. They aren't there to make you rich. They are there, as many times Tom talks about, to push their book or to push their agenda. Kramer is one of those weird guys that has a huge microphone and a lot of people that follow him. My guess is that he's going to take a lot of them with him again. And again, that's because they're not going to understand. It's been 5 years. There can't be a bullet in the chamber. And guess what? That's how come these people hold these stocks all the way down to the lows. And guess what? They have a bad history of selling at the lows, too. Where in the world is Mao? Hopefully our connection is better now. I'm going to try to put the video back up. We were talking, everything going on with the Chinese this week. One of the news articles I saw coming out of China, which I read every night. In fact, we had a big short on in the newsletter. We'll take it off there. We'll turn our video off. I'm not exactly sure why. The video or the audios, the internet speed is great here. Might be a problem between here and the office. Anyway, the news that I saw in the Chinese market was very weird, and that was that quietly this week on Tuesday, they tore down a 122-foot statue of Mao, and no one will say why. And I think it's one of the weirdest things going on out here in the markets during a week where they're trying to adapt to at least some form, I don't know if you could call it actual capitalism, some form of market-based reasoning. And of course, finally, they did something like that last night. I'm not quite sure that we aren't going to find out later on that there was and continues to be controls that maybe they just don't talk about in their market. But I can't believe no one wanted to sell last night. And we'll see more about that in the coming days. My guess is that we'll see the selling come in no matter what. But maybe they've been able to at least slow it down to a little bit. Trading out at 1939 on the S&P cash. And I don't know what else you can say about it other than that, 2.75 billion shares. I'll probably be closing most of or all of my short positions as we go into the close. And the answer is not because I don't think the market's going lower. We'll talk about that a little bit during the show today. One of the other questions out there today was, and why I will be closing my positions probably at the end of the day, is I am expecting margin calls. If you've never gotten one of these wonderful little emails or telephone calls, then you have not lived. You're not a real plunger, as Jesse Livermore used to say. Margin call depends on your broker, but a lot of times, depending on how much cash you have, you can get 150 or 200% margin on your account. A lot of the broker dealer guys will give margins of 10 to 1 for hedge funds and other people. And they stack that up. And sometimes hedge funds have been known to have anywhere from 30 to 100 to 1. I think when long-term capital management blew up, it was 1,000 to 1. And that gives you the problem of a market that can move 1% and you lose 100% of everything you have. That's what happened in, 1998 in November and caused the big to-do and almost the markets imploding back then. But the mechanics of markets that are moving down rather quickly, especially when people are, this happens and margin calls happen when, of course, people are on margin, but it tends to happen not in markets that are going up and down. It has to do with markets that tend to go down for a while. Most of the people that use margins, again, overwhelmingly, 85% of them are margined out on longs. So you don't see the margin calls, although occasionally you do. You see them a great deal more when the market is moving down than you see the market moving up. And again, a lot of people probably haven't been trading, or if they've been trading since 2009, have not really seen the margin call push right into the close. So today you probably want to look at it. The reason why, you normally have 3 market days, depending on your broker dealer, to restore the margin to that. If you get above a certain ratio, that margin ratio means that you have to literally put the money in the same day of the notice before 3 p.m. So let's say that you had a, let's say that like you were 100% long Apple and it moved down 20%, you would have 3 days to basically put the 20% back in. If it moved down 30%, you have until 3 o'clock that day to put the money in. Now, my guess is that we had a bunch of people probably leveraging up. These guys have been buying the dips forever. We also have a lot of people that were margined up going into the end of the year that did not see this huge downside. And I think we have enough movement. And generally, when those people margin, they're probably margining on a leveraged product already to begin with. And that becomes very problematic. But what you will see normally, and why I never cover after a market that's been slammed down, I want to see probably about 3 days of continuing moving markets lower before whether I see a tick index or a trend or anything else, especially if you're going into a Friday. I just know that these guys are out there. I've seen them many, many times, and I know that those margin calls are going to come. I don't know how big they will be, but I know that my best chance of getting my best fill on covering shorts is probably going to happen somewhere when those market orders come in, 320, 330, 340. Look for a low and maybe even a lower low than that going into the end of the day. We'll be back in a minute.
The Path of Least Resistance is David White's daily trading newsletter, and if you're looking for active trading ideas, then now's a perfect time for a 30-day free trial to this powerful daily trading advisory service. David uses his years of trading experience to offer his subscribers his trading ideas each morning in his Path of Least Resistance newsletter. Using a combination of equity trades along with options, David keeps his subscribers up to date with all pertinent market information with intraday afternoon updates when warranted. Don't miss out on this great chance to get a 30-day free trial to David's daily newsletter, The Path of Least Resistance, with no obligation to pay anything. David has been delivering solid recommendations for his subscribers recently, and if you'd like to see the type of newsletter he delivers every morning, then visit the front page of TFNN and you'll find The Path of Least Resistance under Trading Newsletters. For all the details and to start your 30-day free trial today, log on to TFNN.com now. Biotech is booming, but for how long? Whether you think the biotech bull has room to run or has run its course, trade LABU or LABD. Directions Daily S&P Biotech 3 times bull and bear ETFs. Visit directioninvestments.com/biotech today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction shares. To obtain a prospectus or summary prospectus, please contact Direction shares at 866-476-7523. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors. Distributor Foreside Fund Services, LLC. Has the current market volatility continued to stop you out of trades when the market spikes against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped and you have the ability of keeping your trades open even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com. Or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
And we're back. And the mysterious V text from Lutz, Florida asks, can you show a chart of nat gas? I wanted to see the ABCD chart. And if I'm looking at this, the way I would look at it is, you almost or pretty much have to almost go back up to the move of a $14.17 high from July 23rd on the UNG. I don't have the contracts on this computer. My trading computer actually is another one that is pristine and doesn't have a lot of stuff on it, and I know will always go bang when I pull the trigger. And it's sitting over here next to it. It's kind of like the runner-up at a Miss Universe pageant. Other than they won't claim which one is the wrong winner. Boy, that had to be a mess up. Anyway, you've got some little bumps all the way down from the UNG. So if you're looking for what we're getting in retracements now, I mean, we're basically just now starting to get to the 3.82 of that, which is $9.73. So you've got a pretty nice bounce out here. My guess is the first resistance to come in would be at the only gap that's really sitting out here, which is right around that 1050 level. That also comes into some confluence levels, which are more like congestions levels. That would take you at about that 1050 level, 1060, 1050 would be the high of that gap. So if I would have bought at the 691 low, I would have had a plan to sell probably at $10.10, $10.15, assuming that this thing is going to go through and probably touch that gap that goes back to, let's take a look at that gap. That's the gap down on volume, came in at 13.5 million shares on the 26th of October. My guess is that's where UNG could bounce out here. And again, one of the things that you can look at, and I can't prove because I don't have the contracts, but I can almost prove statistically, is that the lower that crude goes, look for more for UNG to go higher. Most of the people are short crude right now and long UNG as the hedge, and the lower crude goes, probably the higher that natural gas goes. I don't think that there's anything implicit in supply and demand on natural gas other than the fact that this thing is part of a cog that's tied directly to crude itself. But, you've got 1060 out here as a 50% retracement and 1148. We'd have to have a miserably cold weather to come out here. And, I'd be my plan would have been either to sell at the 382 at $9.73 and or come out here and look for that gap fill, depending on the volume. Now, you had kind of a great day yesterday in the volume, but no real follow through today. So that may be setting up more for that 382 than the other one. But what I would probably do is just let the market take me out when it got up there. I'd probably just put a trailing stop in and see just how far natural gas could go. What else do we got to go? Got to pack. See if anybody else. If you've got a question, you can email me at path@tfnn.com. You can also call me at 877-927-6648. And during this hour at TFNN, it's known as the Bat Phone. You can also post messages in the den. And we'll start looking at some other stuff out here. But let me know where you're calling from or texting from, and you will not be put in the people from Lutz. And we're ticking off here. I think we got about a 90% chance that we test 1932. Earlier in the den, I said if we hit that 1942 level again today, that's where the volume and the floodgates are going to start opening up. Even though we're not moving very fast, the volume is coming in, 2.85 billion shares. Again, we're going to be a little bit behind everybody else, but going into a weekend, most likely margin calls coming. You'll see those margin calls having to be made by 3. So will people put more money in or will they sell? I know in past margin call routes, like we saw in 2008 in many stocks, 90% of the people choose to sell to meet their margin requirements, and only 10% add more cash. The other thing is a lot of times they don't sell the stocks that are doing the worst. They sell the stocks that maybe they're doing the best on, and it drives people insane. They'll see something like an Apple or a Amazon that's up $5-10 today. What is it right now? 11, yeah, and it's up $3-4, right? And they'll see that and they'll think, okay, well, I'm good. This thing's going to not go very far down the bottom. But in margin calls, it is not uncommon to see stocks that have been kind of higher all day long really get slammed. And it's the stocks that normally have been doing the best that get the worst of the last 30 minutes of the day, as people don't do the right thing. You should sell your losers and keep your winners, and they'll do just the opposite. They'll sell their winners and keep their losers. And a lot of times these stocks just keep going down further and further, and why you find stocks that are stinky that have people that do ride them all the way down. So hope is not a strategy. It actually is. Somebody in the den brought that up, and I brought it up a couple of days ago. You want to hope that your winnings and your profitable trades become much, much more profitable. And you want to fear that your losses will become much, much more larger. And once you get that turned around, you can do it. I also brought up a lottery ticket. What else you say? Oh, lottery ticket. Actually, statistical odds are actually very good in your favor. If you were going to buy a lottery ticket, does it make sense to buy it when the Powerball is 800 million or 20 million? And the answer is 800 million. Your odds are about 10 times better of winning 800 million than winning the 5 or 10 million when the thing starts off every week. Odds are kind of weird things out there. Anyway, we're going to look at some stocks here as we get into it. I want to look at Apple real quick before we get going, because, of course, Apple has been one of those stocks that, has just been all out of love. I'm so lost without you. It is. The only thing is, I've got to wonder whether or not that's the right song for Apple. I think it is, though. Anyway, looks like Apple's headed back down to 42. I wanted to see what the volume is. Now, we're going into options expiration week next week, and that's the reason why I'm going to take my heavily leveraged positions and exit stage right here at the close today. Do I think these things are going appreciably higher? The answer is no. Do I think that they could get Apple back up to 100 or 105 bucks during expiration? I think the answer is yes. They'll come out with 100 reasons why Apple can turn lead into gold and move this market up for a little bit during next week. Even if they don't, they can crush all that wonderful, well-gotten money that I have in these leveraged 3X ETFs, and I will have none of it. I'm taking my money and running at the end of the day. We'll be back in a minute.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock and option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit TFNN.com.
It's true. Life is all about choices. At Everbank, they're making it easy for you to make a smart one with this special cash offer. Open a new yield pledge money market account with funds from another financial institution, or deposit new funds into an existing yield pledge money market account, and you could earn up to a $500 cash reward. And if you're opening a new account, you'll also get their new higher 6-month bonus interest rate, along with their yield pledge promise that ensures your yield will always be in the top 5% of competitive accounts at banks nationwide. Open a new account or add to one. It's your choice. To qualify, you must meet balance and other limited time offer requirements. Go to everbank.com/TFNN for details and deposit options, or speak with one of their banking specialists at 1-855-750-4051 for more information. You must act by December 31st, 2015 to be eligible. Everbank is a member FDIC.
TFNN is excited to offer a brand new piece of market scanning software unlike anything the industry has ever seen. John Logan and his team have spent years developing their market profile tools to finally be able to release the TAS Profile Scanner Plus. And right now, you can get a 2-week trial absolutely free just by visiting TFNN.com and providing us your name and email address. The TAS Profile Scanner Plus is the premier market profile-based scanner in the industry. Powered by the acclaimed TAS proprietary algorithms, this feature-rich scanner is a standalone desktop software that instantly filters over 2,500 global financial markets such as stocks, ETFs, commodity futures, and Forex. Within 3 minutes of signing up, you can have the software downloaded and running on your computer with a complete roadmap of market indicators and inflection points to trade off using the TAS Profile Scanner Plus. Sign up today and try this amazing piece of software by visiting TFNN.com.
This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com.
And we're back. Good question in the den. We were talking odds of winning the lottery. What is it, $800 million or something for Powerball? And I guess the point that I was trying to make was that your expectation is 4 times or 5 times more than it was 4 weeks ago. So if you're going to do something stupid, you might as well do it when the odds are at least more in your favor. And the idea is that if you throw $5 at a lottery ticket and you only have the expectation of getting 25 million, how much better it is to go ahead and throw $5 with the expectation of 800 million. Again, as somebody said, your odds of actually winning are the same as being mauled by a polar bear and a grizzly bear at the same time on the same day. But guess what? There's a lady that's won this 4 times or 5 times in Texas. The odds in that are more than the grains of sand on all the beaches and all the planets and all the galaxies. So just because the odds are against you doesn't mean the expectation is also against you for winning these. It happens. And I'm not saying play the lottery. I'm just saying if you're going to play the lottery, do it when it's 800 million, not when it's 20 million or 15 million or whatever it's starting off. Your expectation is so much better. If you're going to win, you have a much better story. Now, what's a piddly $20 million anyway these days? Pretty soon, you spend 20 million here or there, you actually talking real money. But other than that, bet on the Falcons. That's what you're really talking insanity. And I don't even follow football. Good question in the den, and we're going to get to that. You can also email me at path@tfnn.com. Apple bought a company this week. This company does video analyzation. And the question is, if we can go back up here and find it, it's scrolled back out here. They bought Emotion this week, an AI buy. Would you kindly share highlights where you think Apple, Google, Microsoft, and Facebook are going with AI applications? Most of them, including Microsoft, but Microsoft's actually the first company out with this technology. And of course, we talked about that, and that's where you just sit in front of the webcam in front of your PC, and it unlocks using your facial recognition. And it's not just face recognition. You can't just hold a picture up in front of it. It's actually looking at the infrared signature of your face. And of course, that's in some of the PCs and laptops you can buy literally today. There's actually two cameras in the Microsoft one, a regular camera and another one that has the infrared filter taken out of it so it can actually see the infrared of your face. This technology that Apple bought literally tells whether people are happy or sad. I'm not exactly sure what they think they're going to do with it. I mean, how many things is how many things has Yahoo bought and nothing's ever come of it? A lot of times people buy these things hoping that they can make a silk purse out of a sow's ear. They may be just looking for the people with a background in it. I just don't see the huge application of it for Microsoft and Google, especially Google. The whole AI thing is about identifying what's in the picture so they can categorize it and then search it and sell that search. So anytime you do a image search, they are now getting very good at it, especially Google, finding out people that look the same, people that might do other things. And that's where their work in quantum computers is really starting to heat up, and why they bought some of the first quantum computers out there to start testing whether or not they can do these things that take immense processing power. And that's where the problem is. They may be buying these companies now, but it's going to probably, other than Microsoft's rather narrow way of using some of this technology, it's not real applicable until they get huge processing power. And again, I think that may be why Intel is really working about putting the memory all on the chip instead of having it in separate little bars that you put on the motherboard. They need to be able to randomly access data almost instantly. And those servers, all that technology is all about being able to look at vast amounts of data almost instantly. You can't do it on a hard drive. And that's why Intel bought Altera and why those chips are now programmable. Those chips are going to come out in the near future. But you've got many technologies that have to work themselves out for all this AI to actually work. And in fact, in the 4 o'clock hour, we'll be talking with Tom O'Brien about self-driving cars and maybe all the technology that you haven't thought of that needs to work or come out to make those self-driving cars work. I've written about it in, I don't know, a month ago in the Tech Insider, 2 months ago. But as an engineer, or putting my engineer's hat on, there's a lot of things that I don't think anybody talks about. And those things are starting to actually come up now, and we'll think more about them. Anyway, I'll be over in the studio with Tom O'Brien in the 4 o'clock hour, and we'll be talking about that. Question in the den, if I can find it out here. Smith & Wesson. Take a look at Smith & Wesson. And I don't know what we need to SWHC. Is that it? Smith & Wesson. Big blow-off top out here on Smith & Wesson. I guess that's what they're trying to take out of this. We've talked about the Goldilocks story and how I like high volume to come in. And that is somewhere between 150, maybe as much as 175%. If you get 100%, normally it comes right back in the trading range. If you get about 200%, normally you can get a continued move off of there. If you start getting 200, 300, 400% volume, especially if you get 3, 4 standard deviations out on volume for a pop, I think at 3 standard deviations of volume, you end up, or 4, can't remember now, you get an 80% chance that it goes right back into the trading range also. So this is very much a story, or at least the way I think of it, as a story of the Goldilocks and the 3 bears. You don't want it too cold, you don't want it too hot, you want it just right. Now, when we look at the moves in this, you've got a very nice confluence level right where this thing stopped. And my guess is that you're pretty much right there. 2264 is the low end of that. And my guess is if you were thinking about it, that was it. But if I had been long this into that pop and saw 14 million shares, I would have sold it on the pop. If I would have seen something like, what's the day before? 4 million shares, maybe a maximum of 8 million shares, I may have held it. But when the volume just absolutely goes bonkers like that, normally my first call is 80% of the time this thing's coming back at me, and I go ahead and take my cash. But that's it. And I guess that's the three bears lesson. You don't want it too cold. You don't want it too hot. You want it just right. And if you look at a lot of charts over the time, I've really seen this. That's another Tim Ordism, by the way. So thank him for teaching us all that at TFNN. I think that goes back to like 2002 or 3 or 4. Anyway, we'll see you on the other side of the break.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to The Gold Report, an $85 value, visit the front page of TFNN.com today.
David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
Hi, I'm Steve Rhodes, host of the Trader's Edge, heard daily at TFNN.com and author of Mastering Probability, a daily investment and trading newsletter service that I send out each morning by 8 a.m. My morning newsletter service covers exactly what the markets have been doing since last night's close, providing you with an edge on your trading day ahead. You get actionable trading ideas, including the exact entry, stop, and profit targets. Plus, I'll teach you the patterns and hidden market correlations that will make you a better trader. As a subscriber, you'll gain access to my 90-minute money management workshop, where I'll teach you the secrets that'll save your assets. The bottom line, I've got your back, including a 30-day money-back guarantee. See for yourself the type of analysis I provide each trading day by signing up for Mastering Probability today. With nothing to lose, this is an offer you should not pass on. Mastering Probability can be found under Trading Newsletters on the front page of TFNN.com.
Catch Tom O'Brien, professional trader and educator, founder of TFNN. Also, a special guest on CNBC. Tom will bisect and dissect the markets. The Tom O'Brien Show, next on TFNN.
And we got a ton of questions. Mike asks, he got into SLW for the bounce. Sell it here or wait for more upside? I am not a commodities bull. I think you've got a lot more money to make elsewhere. It may go up, but I think it's going to go up a whole lot less than other stocks go down. I would concentrate on the things that look sick at this point, not the ones where you can make a little money to the upside. I know other people disagree with me and are thinking that a lot of the commodities go much higher. I don't see anything, at least today. Maybe things change next week, but I am not a long-term commodities, even precious metal bull yet. Maybe things change. I want a good signal. I don't think I've seen anything other than a lot of market gas. And again, I would love to buy gold next time I do. I'm probably going to hold on to it for a few years, not just a few days. So maybe my time horizons are longer or different than yours. Other questions in the den? I missed what you said. Did you say you would not be a buyer of options next week, even though you expect a down market? Just saying the market could go down. I suspect the market will actually go up a bit next week. The downside is if you bought calls today, I imagine that all the premium in those calls by time Wednesday comes around will be literally a vapor and dust. At that point, I think that I would like to be buyers of maybe calls or puts, depending on which way the market bounces. But I wouldn't be buying them much before 2 p.m. on Wednesday. That means I may miss some movements. But my guess is that probably the call premium is next to nothing come Wednesday. Put premium also is probably going to be 1/4 of what it is today, or 1/8. So I would continue to look at bad news as even good news being brought in as bad news. What else do we have going on out here? I think I answered all the questions. Is next Wednesday expiration day? No, it's next Friday. But what you will find out is that normally around 2 p.m. on Wednesday, that is kind of like today at 2 p.m. That is that all the weekend premiums are taken out. Wednesday, about that same time, is kind of a tipping point where a ton of premium is out of the market, normally by 1 or 2 o'clock on Wednesday. So if you're playing White Lightning, your odds are much, much better of expectation. Not that the stock's not going to move the way you want to, but if you are going to be 50% right and you're going to buy a 10-cent option hoping to get $1 out of it, you're much better off, instead of paying 25 cents for that option on Tuesday morning, you're much better buying that same option at 10 cents and getting the 10-to-1 back if you are right. So even if you miss it, it's an expectation game. It's not that you're going to be right or wrong. It is, though, the payoff is going to be much, much larger. And probably the lesson of if you're going to do something that is fairly risky, you got to wait until the payoffs, even if this isn't going to be the one this week, is as asymmetric as you can get. And statistically, that's it. I've looked at options. They all point higher for next week. We'll see what they do overnight. My guess is that they'll settle in somewhere around Wednesday and give us a good option picture, and a lot of that's happening today. In the meantime, sell when you can, or in my case, cover all those ill-gotten monies with leveraged 3x shorts before the close of today. And we'll see you Monday. Same bat channel, same bat time. Catch me in the 4 o'clock hour with Tom O'Brien.
Larry Pesavento has just started his brand new service, Fibonacci 24/7, and he's already delivering content to his subscribers on a daily basis when the market's opened and even on weekends. Each Monday, you'll receive Larry's written report that provides detailed commentary and a summary on the charts and videos that Larry sends out. And throughout the week, when warranted, Larry will send out via charts or videos or both the key markets that he is watching during the day. This will be up-to-the-date, active trading information that will help you in your daily trading. In Larry's first week alone, he sent out 25 charts, 6 videos, and a full report to his subscribers in just 1 week. If you're a technical trader that uses patterns and retracements to trade, then Larry's service Fibonacci 24/7 is something that you must try. Right now, new subscribers can get a full 30-day money-back guarantee. With nothing to risk, sign up now to Larry Pesavento's Fibonacci 24/7 by visiting the front page of TFNN.com under Trading Newsletters.
You're watching Tiger TV.